All right, good morning. This is the New York City Fire Pension Fund investment meeting. We are at One Battery Plaza on the 9th floor in the conference room. This is a hybrid meeting with some attendees participating via Zoom. Today is December 18th, 2023. It is 10:14 a.m. I will turn it over to Mr. Dunn for a roll call.
Good morning, all. For Mayor Adams.
Brian Berge, representing Mayor Eric Adams, present.
And for Controller Lander.
Allison Hirsch, representing Controller Brad Lander.
John Dorso, alternate designee for Controller Brad Lander.
Finance Commissioner Nyblock.
Oh, no, like I said, man, no one is going to be able to make it. If that's permitted under the rules.
Yes, that would be.
Then yes. Brian Berge has the proxy for Mr. Philip Dukes, Commissioner Nyblock.
Okay.
Sorry, I was thinking about it in a different way.
Yeah, I know you were, but.
No worries. For the UFA, Mr. Andrew Ansbro.
Bobby Eustace with Andy Ansbro's proxy.
And Mr. Eustace.
Okay, I'll use him. And Mr. Eustace present.
Okay, Chris Viola.
Bobby Eustace with Chris Viola's proxy.
Okay, Mr. Peter DeVita.
I'm present.
Okay. For the UFOA, Mr. Joseph Camastro.
Present.
Mr. Liam Guilfoyle.
Here.
Mr. Sean Michael.
Here.
And for Fire Commissioner Kavanaugh, was that Christoph?
Here.
Present, we have a quorum.
And thank you. So we will start with the public agenda, and I'm going to turn it over to the Controller's office.
All right. Good morning, everyone. We do not have a long public agenda. We have one item, which is a holdover item, which is the discussion on the strategic asset allocation. So we have asked through the last meeting and through the different conversations with NEPC, we've asked about additional scenarios. And at this time, I'm going to turn it over to Doug to walk us through what's been presented this morning and any comments or additional updates that we'd like to provide.
Great. Thank you. So these mics are what we're using?
Yes, you don't need to.
Okay, great. So if everyone on the phone can hear, as a follow-up to the November 6th meeting, we had a caucus meeting with UFA. UFA went through some additional mixes that were focused on really two things. One, the hedge fund allocation, discussing either keeping it at 5% or looking at 4 or 3%. We also looked at some mixes consistent with November that had 0% in hedge funds. I think through that meeting, we reached more of a consensus with the UFA and the UFOA that we would look and focus on mixes that are either 3 or 4 or 5% hedge funds, and then make adjustments to the equity ratio is kind of an offset. So the equity ratio is kept a little closer to the current target. Right now, the U.S. equity ratio is on the current policy. When you add large and small, mid, it's 27%. The total equity ratio, including private equity, on that current policy mix that you'll see in the document that was posted this morning, which has an additional mix that I also emailed to the group. You can see that mix A, B, and C, and D all look at slightly higher equity ratios, with a big part of that being the private equity increase, right? We're increasing private equity from 8 to 12 in all of those mixes. And so the difference really is how much do we trim large cap, and the mixes there are, mix A is the one that NEPC recommended is 24% to large cap, so that's a decrease of 3. Again, most of that, all of that really going to private equity. And then there were some small adjustments to hedge funds at the bottom of the page. Mix A has it at its current target 5, and then there's 3 more mixes that look at 4 and 3% allocations. All of these mixes are very similar. There's small adjustments to the bond categories as well. You'll note the U.S. Treasury bond, which, you know, we are reducing in all of the mixes, goes down to either 8.5% or 9%. And the expected return at the bottom, the 10-year, which is the shorter time horizon, all just below 7%. Again, when we looked at this back when rates were much lower, cash rates were close to 0, and bond yields were closer to 2, these numbers were much lower than 6. The expected 30-year return, which is more coincides with the actuarial time horizon, you can see we're all comfortably around 7.8 to 7.85. The risk does go up slightly with the increased expected return going from 7.5 under the current policy to the on the 30-year to the 7.8, 7.85 range. So NEPC is comfortable with all 4 mixes, and it really comes down to the board preference, presumably on the size of the hedge fund allocation and how we offset any decrease to that. I'll pause there for any questions, because I know this is the 3rd meeting we've had to talk about this, so I think everyone's kind of pretty familiar with it. I know the mayor's representatives have gone through this process with several of the other boards, so they kind of have the perspective of what the other boards have already either approved or are still discussing. I don't know if there's any questions at all.
I guess the big question that I have for my fellow trustees is, how do folks feel about the U.S. large cap piece? You know, the two that really stand out is the one at 21% and the one at 23%. Is there a preference towards one of those? I know we're playing on the margins here. That's why I'm asking, like, if there's a strong preference.
Personally, I like D. I think D is the fair compromise of all of them. Kind of touches the fringes of everything we were talking about, and still keeps our equities at a level that we would have.
I agree.
And I'll just make one note on mixed D. I didn't adjust the decimal there. The large cap allocation is 21.5, so when you take the vote, we should note that. And that means the total equity is 51.5, and that's offsetting the cash, which is the 0.5. I did have Wilfredo post that updated, fixed, corrected version.
Yes.
Everything else is to the 0.0, so there's no rounding needed.
Can I ask a question to the mayor's people?
Sure.
Do you feel, again, you've sat through the other boards, do you feel like these numbers keep us in line, or we're not an outlier compared to the other mixes you've seen?
I mean,
Without violating
off the top of my head, no, off the top of my head, I mean, it's all at least correct.
Yeah.
And honestly, this fund should probably be tilted a little riskier than some of the funds, because
a little more aggressive,
a little more,
capture for.
a little more catch-up is needed.
Yeah, I mean, I could tell you that, just speaking from a control group, the only noticeable differences between this fund and the other fund is 2 of the funds have no allocation to hedge funds.
Right.
And on one of the other systems,
That's
they
always
have
gonna be the
convertibles, where we don't have convertibles here. Other than that, they're all somewhat consistent, and I think the rationale behind that is you're all large, complex plans, and you all have the same target, so you're always going to be they're all going to be somewhat similar if you were to line them up together. They don't deviate that far from
Yeah,
one another.
it's a tiny bit more aggressive,
Yeah.
but to me, that makes sense.
Doug, do you feel this is the biggest, because the basket clause, we just came out of it, this is our new look?
Yeah.
Would you see, like, next year, that we wouldn't foresee at least a big shakeup, or be just fine-tuning these numbers?
Yeah, I don't see a lot of change. I mean, when I think of the where we are today, and I started working with the board about 17 years ago, the path you've been on, the primary path, is building out your alternative portfolio. And that is kind of getting close to the end of that path. You know, we may decide at some point you're slightly more comfortable with 14% in private equity or something like that, or real estate where we've sometimes struggled to get the money back to work. Might tweak that up, but no, I don't see a lot of big changes. You know, interest rates may have peaked, but maybe not, and so the big adjustment here is partially driven by, again, continuing that path with our alternative portfolio, but also the fact that we're in a much more attractive environment for pension funds with bonds, so we're kind of tweaking our mix in the middle of the page to the different categories of bonds, including, we're getting rid of TIPS because of the way that they tend to act in some periods of deflation or recession.
Really just a downside,
9 on the.
as long as it's going to be a downside edge. Because if this number also do,
Treasury
people,
rate,
including-
I mean, a dramatic change from where they are today.
There's
We
no-
can revisit that. And I guess redistribute within
We're just doing.
Yes, absolutely, absolutely. And that bucket is the biggest part of the fixed income
question, does anybody?
market. And it's also considered to be, sorry, I'm answering it. It's also considered to be the safe place, right, the most liquid, and that's why we want to keep an allocation of at least 8 or 10%. It was a little bit high when we had 12 and we had 4 in TIPS. And so I think making those adjustments is appropriate, and we can always visit those adjustments.
Can I ask you a question, and again, only because C is the only other one that I find tempting too, with the 3% hedge fund allocation.
Yep.
Again, just not tempting, it's a weird word to use, but looks interesting in the grand scheme. I just, again, back and forth, and the more you read, like even at, I know it's like at 3%, why do we even have hedge funds? At 4%, why do we even have hedge funds? And I know why we have them, but at 3%, what are we actually hedging? Anything if there was a...
It acts, again, with risk like bonds, it can be countercyclical and less interest rate sensitive, so it's like having, another lower risk category asset that may do well in a equity sell-off or a bond sell-off.
It's like a 3 basis point over the 30 years, and it raises the risk
It
a little bit.
It raises the risk when you reduce the hedge funds, yeah.
Right.
So, I mean, what I would say to you is, we would have to, just practically speaking, you have an existing hedge fund
I don't know.
portfolio that's at cost. So either way, you're gonna trim some of it.
So where'd that 1% go? Oh, so we're back up.
And I think what we would ask Axia to do is to look at the portfolio if we adopt the 4, even if we adopt 3, right? To look at the portfolio and figure out what we have existing, because we have a 5% allocation today, what would we keep? And what would we trim back on? And I think the secondary question is, if we decide to keep one of those 2 options, what are we using the hedge fund bucket for? And we've talked about this notion of it's not really there to generate alpha as much as it's to be a risk mitigator, and I think we would charge the consultants and BAM to figure out what mix of the existing makes sense, or if we need different managers to satisfy that.
Yes.
I think we have the framework, by the way, of what we want to do. It's just a matter of making it more bespoke to the fire one.
Do we dedicate, and again, I'm just asking this, do we dedicate resources of BAM and now Axia at a 3% of the entire portfolio? Are we dedicating resources away from other things when we really feel it may not be much of a gain?
No, because, one of the other systems has an even larger allocation to.
So it would still be there anyway?
Yeah, police is raising theirs.
Yes.
Yeah, police is raising their 6,
6.
5 to 6, I think.
Yeah. So the resources are there. It's not it's not a drain. It wouldn't be like any.
I was just curious if that was,
That's a fair question, but.
do we have like a straw poll? Like what is the general consensus of the table of having hedge, keeping it same, less? Like what's just, as a standalone, that portion of it?
So.
3, 4, and 5.
I'm gonna give you my
Yeah.
personal opinion on this.
Yeah,
My personal opinion on this is, we have an existing portfolio. We have rates that are gonna settle in at some number that's not the number that it is today. And I think Al even said he's gonna drop rates essentially 3 times next year. What I'm afraid of is, we're looking at the portfolio at this moment in time, this snapshot in time, we decide to get out of something, or even double down on something, like, you can go double where you are. And then we turn around within a year's time, and we're in a different place, and we either can't get back into the stuff that we realize, we should have remade the portfolio while we had the chance, and we can't go into something. Or, we made a decision that hey, we doubled down on something we shouldn't have done. So I guess my feeling on it is, if you're comfortable going to 0 and calling it a day, that's one thing. but if we think that the market's gonna change to the point of, we wanna revisit this, then it doesn't make sense to kind of throw everything out and start from scratch.
Can I,
Does that, I mean,
yeah, it does.
as articulate as I could be.
I'll, if I could take personal privilege and make a point about the fixed income market and next year, and if Steve's on, I'd hope that he would chime in with his view. We just had this week where the Fed met, right, and all the talking heads on TV are talking about cuts next year, right? And presumably that's because the economy is still slowing, and whether it's a soft landing or not, I don't think makes that much of a difference. It makes a difference, but what I think the market is forgetting right now is that the Fed only controls the cash rates. And so if they cut or don't cut next year, 1, 2, 3 times, whatever it is, the yield curve right now is inverted, right? So the 10-year is at a lower rate than the cash rate. If cash rates come down, it doesn't mean that the rest of the bond market, the yield curve comes down. And corporate America borrows at that 10-year maturity. And so rates could go up on the 10-year, even if they're coming down on that. And that'll hit earnings, and it'll hit, you know, defaults and things like that. So I think the media is very short-term oriented when it comes to the Fed, and as investors, I think we will absolutely reevaluate anything when rates change. But I also think that there's still some choppy waters ahead. The Fed the U.S. Treasury still has to issue a lot of debt into the market, where Japan and China, who used to buy 50% of our debt, may not be buying as much. So there's lots of things that can kind of get off, you know, that can change in the fixed income market. I don't know if Steve's on or is he out today?
Steve is sick.
Oh, okay, sorry, didn't know.
Appropriate to have,
I mean, I think they're in the room, so I think it makes sense.
but, guys.
Yeah, so why don't you guys come, and just introduce yourself to the record.
Sure. Brett Manera, Maxia. Look, I think all the points raised are very valid. I would concur with John. There's a lot of embedded value in this portfolio. There's a lot of strategies that, if the goal is to move to a more pure risk mitigation mandate, there's a lot of strategies that are going to add a lot of value at the plan level and really act as a preservation of value, especially in times of increased market risk and market volatility. And that's really where these strategies tend to pay off over the long term, is in protecting that downside. Historically, if you look at the track record, that's what you've seen in periods of equity sell-off and increased volatility, this portfolio really preserving capital and protecting on that downside. It's not going to keep up when equity markets are rallying. I would have a hard time making an argument. Maybe Doug could. I don't, think that the equity markets right now are in a strong place where we expect, positive upside performance in a strong way, right? So having an allocation to a protective asset makes a lot of sense. Obviously, it's our business. We do a lot of that. So, it's not our place to set top-down SAA guidelines. Whatever you guys deem appropriate is fine, and you can work it out in the portfolio. I would just simply say, don't overlook, the baby that's in the bathwater. There is a lot of embedded value in that portfolio that I think can be useful for, achieving the long-term objectives. And one of those things you can use hedge funds for is reallocating during times of market stress, right? So you've got strategies that protect when equities are in drawdown. You can actually then harvest that capital and redeploy it in distressed assets, in stocks when they're sold off, right, in bonds when they're cheap. So you can be more tactical in this allocation over the long term than simply kind of setting it and forgetting it at a certain percentage as well. So that's one thing to keep in mind.
Oh, thanks. Again, I always, when we talk about volatility, where it seems like, again, we're moving the Queen Mary. So it's where, as much as we don't want to hit volatility short term isn't automatically our greatest fear. It's the long-term trending, right? I mean, it's,
Yep.
Is our hedge long-term or our hedge short-term, because we're going to be reporting these numbers? It's not affecting our ability to make payments on the pension fund. We're talking about long-term growth of the pension fund. It's a weird dynamic, because we're almost fearing the quarterly or the annual report that's going to show the fund down, when we were talking the other day, long-term is a lot of short-terms put together. But it's hard to, the next year of volatility, if it's a downward, again, if it's more bearish than, again, our projections are, how big of a concern is that if we're long-term investors? Is it more because of our reporting? Because we're in bad ideas, we're institutionally having bad thoughts about the.
So when we're evaluating hedge funds as a category, we want to see how it does long-term, and we view it as having a very strong positioning between stocks and bonds with risk like bonds, and that's our long-term view, and we think from a long-term time horizon perspective, it makes sense to have it. But we also like that hedge funds are counter-cyclical in short periods. 2022 is the best example. First half of the year, stocks and bonds sold off. Your hedge funds were flat and had some positive months as well. And so we take both views, you're right. And it's not that we're fearful of the year ahead or the 2-year period or a bad quarter. I think the primary driver with NEPC's assumptions is what Brett just said, is we don't view the equity market in the U.S. as having a lot of upside to it because of where it's valued. And it's had a really strong year, in particular the last, the capping it off for the last 2 months. So that means that our assumption for the forward-looking is down a little bit. Hedge funds tend to be a little bit more consistent because it isn't as market dependent, right? It's, volatility in the market is usually a good thing for hedge funds. Inflection points are typically a good thing for hedge funds, and so that's one of the things we like about them.
That's what, correct me if I'm wrong, but it's a preserver of capital.
Yeah, that's right.
So you really lose on that downside if it's not much longer to come back to where you were and then move forward.
Yeah, and I think all we're trying to do here is create a balance in the portfolio. Your current policy has balance, and we're making some adjustments that are long-term, like adding more to our private equity target so we can adjust our pacing. Same for private real infrastructure. And then we're making some adjustments between hedge funds, fixed income, and public equities. So not a lot of serious change here other than some of the things that we are already kind of comfortable with, like private equity going up.
The only question I have, and it's completely away from hedge funds, I'm comfortable with it, is are you, in regards to treasuries and corporates, do you see treasuries in the short and the long term coming down and corporates doing better, or?
Yeah, so corporates over time always trade at a premium, a yield premium to treasuries. So if you're in the investment grade space, it's 150 basis points, so 1.5% or so. In the high yield space, it's more like 4%. So those are the premiums that we capture by, in this case, we're moving our corporate bond allocation from 4 to 6. Mm-hmm. And we like that, right? And so we're trading off higher return for corporates with a decrease from TIPS and from U.S. Treasuries.
And I just want to remind everybody, these assumptions are always based on the market, not any benefit we get from manager selection. Correct?
Yeah, that's right. I mean,
So,
yeah,
a good corporate manager or a good, treasury manager or a good mortgage manager, theoretically, that might be alpha that's generated on top of what you're seeing here. This is just a passive option, right? So
right.
I think that's something to always keep in mind, that we have had a knack as a board, with the help of BAM and NEPC, of picking good managers in these spaces. So I think that plays out over time too, and it's only a benefit to us. Not 100% of the time, obviously, but.
So do we need to make a motion on this?
So you would make a motion on whichever option you want, and if there's consensus, we'll just move ahead.
So I would make a motion to move forward.
Okay, so I guess we'll just do it because it's, all those in favor, please indicate by saying aye.
Aye.
Any opposed, any abstentions? Hearing none. Okay, the motion carries. We have adopted Mix D as our asset allocation. Now, just a side question, because we've had the conversation about what the hedge fund portfolio would look like, is there any direction we want to give BAM and NEPC, BAM and Axia on construction of the portfolio, to look at things that, to shift it a little more, risk mitigation, or, and they don't have to do it today, but should they come back to us and?
Yeah, obviously, everything should be done as prudently as possible.
Okay.
But, yeah, I think we discussed that.
Okay, so I just want to be clear for Axia's benefit. I think the charge from the board is to,
Outside hedge.
is to do an evaluation of the portfolio. I'll speak on behalf of the board here and just interrupt if you think I'm wrong. Do an evaluation of the existing portfolio and come with some recommendations on actions we would take in order to have the hedge fund portfolio more aligned with what you've heard over the last couple of meetings as far as what the board is looking for and the role the hedge fund plays within the program, and also recognizing the allocation is going from 5% to 4% anyway, and how that would impact.
So just a question about that. So if we're talking about making our particular hedge fund portfolio take particular stylistic slant, is that modeled in the return and risk assumptions that are used for producing the model asset allocations? I mean, because then, is that number not?
Yeah, in the modeling, there's not a lot of difference. We do have separate assumptions for global macro, relative value, long-short equity, and one other category. I actually put them in the presentation. There aren't a lot of differences in the expected return. There's slight differences, and then the betas are slightly different. And I don't think it would make sense. It would make a difference at a 4% allocation if you adjusted the assumption for building a more counter-cyclical portfolio versus the portfolio you have right now, because it's a rounding error. It becomes a rounding error from the modeling standpoint. But I think we can revisit, that as Axia goes through their process with BAM, talking about how the portfolio might be repositioned.
Sure. I certainly don't want, I mean, this process has been going on for a while. I don't.
No.
But
It's definitely.
Sure, everyone is cognizant. It sounds like you are. We don't want our portfolio construction actions to be excluded from our modeling used for the asset allocation.
And also, partially because I love the expression you said with the bathwater, while phasing down from 5 to 4, where that's a slow and steady process. That doesn't, if there's value in the bathwater, we're not going to start dumping, and we're also going to look at any managers that are on the watch list, and that's where we'll start limiting from first, or how does that work?
Yeah, so this process always involves,
I was asking, I don't know off the top of my head.
there's always considerations, right,
Okay.
in both directions. The first place to start is, if we were building a new portfolio today, where is conviction the strongest, right? Where are the managers that are most aligned with your long-term objectives that form the greatest likelihood of meeting the risk-return targets that you guys have set? Right? So that's the first place always. So if we were building a de novo portfolio, to whom would we allocate? And if a manager is not one to whom we would allocate, that's a natural place to start. So it's not necessarily considering recent performance. We don't want to be chasing performance. However, we do want to consider things like embedded high watermarks. So hedge funds, specifically, if they are below their previous high watermark, you're typically not paying an incentive fee on that performance until they get up to their high watermark, right? So it's a much cheaper strategy in that near term, assuming we can believe that they will hit that high watermark. Might make sense to make that a more medium-term phase-out more than an immediate phase-out. So these are all kind of factors that we'll consider as we talk about the pacing of this. The other thing to keep in mind, in addition to how expected risk and return profiles change, is the IPS does lay out specific guidelines for this program, especially in terms of benchmarking, risk targets and limits that are allowed. So that's one thing I like to raise that we should likely reconsider, are the stated objectives of the program in the IPS. We want to make sure that those are consistent with your objectives and what you're looking to accomplish as we make this change. We don't want to make any changes that are then inconsistent with the IPS.
So
We're jumping into the IPS right after.
Okay, so it's good timing.
perfect time.
We're happy to pair our recommendations.
Happy to for,
It's been way too long.
And we're happy to pair our recommendations for the portfolio change with those IPS recommendations so that they align.
Great. So we'll look forward to, in the coming months,
If you're having
presentation
trouble getting
from Axie and BAM on the state of the hedge fund portfolio and recommendations going forward to get us in the start.
That's good.
Yeah.
Just one question I have on hedge funds. We have a plus or minus 2% on the 4% anyway, correct?
I think that that's fair on everything in the portfolio, is about plus or minus.
Is there any one category in hedge funds, which formed in categories of investment in hedge funds, that off the top of your head, you would be leaning away from and toward another?
The best way to think about strategies, aside from the categories, the categories are labels that external participants apply to these managers. They would actually, maybe some of them would describe their strategies differently than we actually describe their strategies. So one of the better ways to think about them is what we call the utility function, the portfolio utility that they serve. There are strategies that are meant to perform in line with upward trending markets and really capture market performance. And there are strategies that are meant to perform consistent regardless of the market's performance. As kind of two broad groups, there's flavors within those categories. The former group is the one that's likely to be least appropriate for the change that we're going. So what we're not looking for are beta-dependent or market-dependent strategies that require the market moving in a positive direction in order for them to perform positively.
Gotcha.
So we'll most likely focus on the strategies that we call more diversifiers, more pure alpha strategies, more focused alpha strategies, with strong downside protection. And those strategies should perform consistently, fairly regardless of how the market performs.
Appreciate it. Thank you.
All right, so I believe that concludes the public agenda. If there's no other business, I'll make a motion to exit public session and enter into executive session. Do you want to? Second.
Exactly.
No, just wait really quick.
Wait.
I was hoping to have a tiny bit of commentary on the subject of the FY24 budget from Pat. I do not believe it's a voting matter. And then
Is that for this meeting or next, with the regular
I'm
meeting?
just the only one I'm going to be at.
Okay, all right, so I'll withdraw my motion to exit.
So, as you all know, we've had some discussions about the desire on the part of the mayor's office and my function as representing the mayor's office on the board to secure budget cuts from all of the pension funds relative to the FY24 adopted budgets of 5%. I would say commensurate to the PEG on city agencies, but that's not even really strictly true because city agencies had other PEGs before this and other PEGs have come in, PEG after PEG. So it's really just a directional effort that we're hoping for. We've had a pretty ample discussion. I really appreciate everyone's engagement on the subject, and I believe we've reached a conclusion, and I'll just leave it to Pat to describe what that is, because I don't think we're looking for a board at this.
Well, I'd like to thank everybody for their input. We've all discussed, the methods and manners of, being cooperative, of course, with the administration. And the fund commits to meeting the cuts as we've discussed for the pension fund to return funds to the city, and no board actions required, and, on to the next day. But I thank everybody for their input.
I really appreciate your engagement on this, Pat, the hard work that you're doing, because I know it's not easy. I know y'all are not funded to the level that you would like to be already. So this does not go unnoticed by me. I'd like to make representations on behalf of the whole city. I'm not sure if I can do that, but it certainly doesn't go unnoticed by me. So I really appreciate that. And we're not taking an actual reduction to a formally adopted budget. This is Pat taking some administrative steps to secure savings that he can find, and that's why we're not voting.
And I commit those savings on behalf of the fund to the board to be provided to the city. And I would just also like to acknowledge that, Mr. Berge's always been an open door policy. Obviously, we all have different roles to fill, but, Mr. Berge's been an honest broker. I think we all agree for the fund, and, in difficult times, even when we disagree, we've never been disagreeable, and your professionalism is much appreciated by the fund and by the board, Brian.
All right, well, thank you very much. Let's take this goodwill into the fiscal 25 budget season.
Okay. So with that, I'll make a motion to exit public and enter into executive.
Second.
All right.
Any
So,
opposed?
No.
Hearing none, the motion carries.
Great.
Please turn off the recording. Executive session, the board discussed various investment matters. There's further on our agenda.
So, motion to adjourn.
Any opposed? Hearing none, the motion carries. We are adjourned.
You're
Thank
very
you
quick
all.
with the adjournment.
I'm very quick. All right, thank you, Bam.
Don't do